Hello, my name is Crystal Dahl, and I'm the Online Communications Specialist here at Meritas. I would like to welcome and thank each of you for joining us on today's webinar, U.S. Tax and Estate Planning for Foreign Persons. Before we get started, I'd like to quickly go over a few housekeeping items. Meritas now offers the ability to listen to our webinars through your computer speakers. If at any time you have any difficulty hearing the presentation, you may call into the associated telephone line instead. All phone lines will be muted. If you experience any technical difficulties, please press *0 at any time to connect with a support technician. You may also use the chat feature found on the left-hand side of your screen to reach out to us to get some of that resolved as well. Since you will be muted, if you have any questions, please ask via the chat feature found on the left-hand side of your screen. Matthew plans to answer questions at the end of the presentation. Lastly, in the next few days, I will distribute a copy of the presentation, a recording of the webinar, as well as Matthew's contact details. Our presenter today, Matthew Hillary, comes from the Meritas member firm in Boston, Massachusetts, Goulston Storrs. Matt is a director of the Private Client Group and concentrates his practice on estate planning for high net worth individuals and families, trust and estates administration, the formation and operation of nonprofit charitable organizations, and issues related to charitable giving. Goulston Storrs has one of the largest trust and estates practices in the Northeast. With that, Matthew, are you ready to get started?
I'm ready.
Great. Go ahead.
All right. Thank you, Crystal. And thank you to everybody who is tuning in. Just begin by saying that this is estate planning for foreign persons is a topic that actually comes up a lot in Boston. We have a lot of schools, universities, hospitals, tech companies, investment firms, and the like, and people tend to come and they tend to stay. And as they stay and as their relationship with the U.S. becomes more permanent, they become sort of more and more enmeshed in some of the estate planning and tax rules. It's a complex area, but I have found it a very rewarding area in which to practice. And it's a growing area because international issues have been the subject of an awful lot of legislative and regulatory focus in the United States in recent years. And with a mobile society, I expect that that trend will continue. So the slide that's up now is just an overview of what we're going to cover today. We're going to touch on sort of some of the big issues that apply to foreign persons moving to the United States. This is an overview, though, rather than a deep dive. The focus will be on estate planning and especially tax issues, but not necessarily immigration. Notwithstanding that, our first topic will be an individual's immigration status, then wills, trusts, and other estate planning documents, a discussion of what types of people pay U.S. taxes and what kinds of taxes, and then issues related to non-citizen spouses purchasing a home, so-called challenging assets, and last but not least, expatriation. So for tax purposes, there are three general categories of person. There's a U.S. citizen, a non-citizen resident, and a non-resident alien. Each of these different categories has different benefits and burdens, whether it deals with border crossings, voting rights, access to government benefits, ease of employment, or taxation. Generally, the tax burdens increase as a person's connections with the United States become more permanent, with a U.S. citizen obviously being the most permanent. Because of this, it's important that an individual go and consider what the implications will be over the long term before increasing their contacts and upgrading their status. Because frankly, it is hard to go back. It can be very difficult to go and move from U.S. citizen to non-resident alien or non-citizen resident to a non-resident alien because people become enmeshed either through a job or starting a family here, purchasing real estate, or just their lifestyle. It is not exclusively a one-way street. After all, expatriation is the process of leaving the United States, but in general, it's hard to go back. So, before we go and get to taxes, though, I just want to say a word about basic estate planning documents. I often talk with clients, often business owners, who have come to the United States and have begun to put down roots, but who in their minds think that they may go home someday. Well, while they're here, though, they do need some form of basic planning in case something happens. And I've put up on the screen a series of documents that I would typically discuss with a person who is coming to the United States and living here for some period of time. Not necessarily permanently, but some period of years. The first of these documents is a local will. And a will in the United States does a couple of different things. It appoints executors to administer an individual's estate. It can appoint guardians to take care of minor children, and it can dispose of property. For many clients, guardianship of minor children is the number one consideration and the thing that first gets them in through the door. But property disposition is the thing that lawyers will concentrate on oftentimes because it can be much more challenging. Clients may not be aware of the operation of law in the United States, where in a state like Massachusetts, if a person dies without a will, then state statute dictates how a person's assets are to be disposed of, typically to an individual's closest living relatives. This can be overcome by signing a will. And if a person does sign a will, then absent rights that remain with a surviving spouse, an individual is generally free to go and dispose of property however he likes. The will can apply, in theory, to all of an individual's worldwide assets. But many clients will go and sign more than one will. So a will, for example, that applies just to U.S. assets and a will that applies to assets back home. The reason for doing this is that it can be difficult to, but not impossible, to probate a foreign will in a U.S. court. It might be necessary to translate the will. The terminology might be unfamiliar to the judges and court personnel here, and the powers that typically are used by an executor here might not appear in the local will, and vice versa. A U.S. will might not be ideal for disposing of property in a client's home country. So this is the sort of thing that's permitted in the United States, but certainly something that needs to be coordinated closely with a client's other advisors in order to make sure that there are neither overlapping provisions in the will where different wills control the same assets, nor are assets forgotten. For many clients, They will sign not just a will for property disposition, but also a trust. This practice varies state by state in the United States. In some states, the trust is part of a will. In other states, the trust is more often a separate document. Massachusetts, where I live and where I practice, falls into the latter category, where the trust is separate. And a trust can be important for any number of reasons. First, it is often the place where a lot of the tax planning occurs, especially for purposes of U.S. estate, gift, and generation skipping transfer taxes. So the property transferred to the trust can be divided in any number of ways into different subtrusts, all of which have different tax attributes, in order to take advantage of a person's available credits, exemptions, and deductions. The trust is often the long-term asset management vehicle for children, especially young children where parents don't want them getting assets immediately. Trust can be incredibly useful in terms of privacy. Here in Massachusetts, a will is a public document. You can go to a local probate court and look up the will of any deceased individual. Not so with a trust. A trust typically is not filed with the probate court. So a standard estate planning device is to have a will that leaves the residue of an individual's estate to the trust. And after that, prying eyes cannot see what happens. Trusts, though, in the United States can have tax considerations in an individual's home country. They might not be recognized for property law purposes. They might lead to an immediate recognition of gain or a form of inheritance tax after a set number of years. So it's important to coordinate with home advisors. And trustee selection can have big impacts in the United States because the presence of one or more non-U.S. trustees can go and change the income tax treatment of a trust dramatically in the U.S. We're going to get into this issue a little bit later on. Lastly, I've listed durable powers of attorney and healthcare documents. These are really incapacity documents. So a durable power of attorney is primarily used to make financial decisions for a person known as the principal if the principal is unable to do so himself. While healthcare documents, and they go by different names in different states, are often used to make medical decisions for a person who is incapacitated. I think it's very important to go and have a set of these documents for the U.S. and also perhaps a separate set back home. Incapacity can come at any time, and it's important to have people in place who can act, but also documents from a person's home jurisdiction may not be enforceable or easily acceptable in the United States, and vice versa. U.S. documents may not be accepted abroad. All right, let's move on. So now we're turning to tax issues. Who pays U.S. taxes? U.S. citizens have the greatest tax burden under our system. They are taxed on worldwide income. So earnings from a job in the U.S., earnings from a job abroad, gains from the sale of assets in the United States or overseas, all are taxable by the United States government. It doesn't matter where the money comes from. If you're a citizen, it's taxable here. Similarly, in the case of the estate tax, the gift tax, and the generation skipping transfer tax, which are taxes on the transfer of wealth, these transfers are subject to tax everywhere. So if an asset is transferred in the United States, if an asset is transferred abroad, it doesn't matter for purposes of the U.S. tax system. It's all theoretically subject to U.S. transfer taxes. The United States is a party to both bilateral income tax treaties and, to a lesser degree, bilateral estate tax treaties that can lessen the bite of double taxation if a person is subject to tax in more than one jurisdiction. So when working with a client who has ties both to the United States and to a particular known jurisdiction, it's always important to consult the treaty, and they're all typically different. Though there are models upon which the treaties are based, each one is negotiated separately and contains its own provisions. After citizens, we have non-citizen residents. These are people who reside in the U.S., and we'll get to what that means in a moment, who are not citizens of the country. If you fall into this category, you are also taxed on worldwide income, just like a citizen, though non-citizens cannot vote. Non-citizen residents typically fall into two categories. First, there are legal permanent residents, also known colloquially as green card holders. And then there are people who pass what is known as the substantial presence test. The substantial presence test is based upon physical presence in the United States. And it's really an exercise in counting days when a person is here in the U.S. The individual has to be present in the U.S. for at least 31 days in the current taxable year. After that, the individual also has to be substantially present at least 183 days during the current taxable year and the prior 2 calendar years. So it's look at 3 years in order to determine the substantial presence in the current year. You count 1/3 of the days in the preceding year and 1/6 of the days in the second preceding year. Any presence on a single day is counted as a full day, but there are exceptions for certain favored types of individuals. So people who work with foreign governments, teachers or trainees, students, there are even exceptions for certain pro athletes. There is a separate rule for capital gains, though, and that is a strict 183-day rule. So an individual has to be present in the U.S. for 183 days in the year of gain recognition in order to be taxed, although the rule is somewhat different for the sale of real estate, as we'll see later on. A non-citizen resident also can be subject to estate, gift, and generation skipping transfer taxes on worldwide assets if the individual is domiciled in the United States. So residence and domicile are not equivalent. Residence, at least with respect to the substantial presence test, is a strictly mathematical numerical test. Domicile, on the other hand, is a little more squishy. The regulations indicate that a person acquires domicile in a place by living there for even a brief period of time with no definite present intention of later removing therefrom. Residence without the required intention to remain indefinitely will not suffice to create domicile, nor will intention to change domicile affect such a change unless accompanied by actual removal. In other words, there's a subjective standard associated with domicile. It's usually a safe bet that an individual who has a green card probably is domiciled in the United States because they have made a commitment to living here. An individual who is taxable under the substantial presence test may be domiciled or may not be. it's usually an issue that is worth exploring. So this next slide shows some examples of how the substantial presence test works. You can look at them in greater detail, but basically we're trying to determine whether an individual is substantially present in the United States in 2016 based upon the number of days spent in 2016, 2015, and 2014. In the first example, Jack is here for 90 days in 2016, 210 days in 2015, and 180 days in 2014. When you work through the math, he is counted as being substantially present for 190 days in 2016, which makes him a non-citizen resident. Example 2 uses different numbers for Jill with a lower number of days in 2016 and higher days in 2015 and 2014. We've manipulated the numbers in order to make her substantially present for only 175 days this year, which means that she's not taxable as a resident. If you sit down and calculate out the numbers, that in order to determine a consistent number of days that a person can be in the United States each year without reaching 183 under the substantial presence test, 121 days per year seems to be the limit. So if an individual has business in the United States, plans on visiting regularly, but does not wish to be substantially present, keeping the number of days spent in the country to 121 or less should work. So the treatment of non-resident aliens under the U.S. transfer taxes is complicated. They're not going to be domiciled here, so it's not quite so easy as with a non-citizen resident. For a person who's a non-resident alien, the estate tax applies only to U.S. situs assets. And these typically include real estate located in the United States, tangible personal property that is physically located here, and stock in U.S. domestic corporations. Certain kinds of favored investments are not considered to be U.S. situs assets by statute and can be held by non-resident aliens free of U.S. estate tax. So this includes portfolio debt, life insurance on the life of the non-resident alien, bank deposits, and shares of stock in foreign corporations. With respect to bank deposits, the non-resident alien has to be careful to truly understand what kind of account they're getting. Money market funds in the United States are organized as mutual funds and involve the ownership of stock in U.S. corporations. So the careful non-resident alien will make sure that they do not own such a thing. At death, when a non-resident alien dies, there's a step-up in basis for that person's assets, whether or not they would actually be taxable for U.S. estate tax purposes. So, for example, if a non-resident alien dies owning real estate abroad, that real estate receives a step-up in basis to its date of death fair market value, though it's clearly not taxable by the U.S. For estate tax purposes. If the non-resident alien then transfers that property by will to his child in the United States, the child takes the property with a basis equal to the date of death value. It's quite a benefit. The gift tax is actually even more forgiving for non-resident aliens. So the simple rule is that there is no U.S. gift tax at all on transfers by non-resident aliens by gift of intangible assets. And let me just take this opportunity to point out that in the United States, estate taxes are paid by the estate of the decedent, and gift taxes are paid by the donor, not by the recipient of the gift. So if a non-resident alien owns cash, marketable securities, whether they're U.S. corporate stocks, bonds, or not, copyrights, any sort of intangible property, that person can go and give it to an American or someone who's not an American, absolutely free of U.S. gift tax. You'll see that there's an exception in there for certain expatriates. These are generally people who expatriated before a particular date in 2008 when our expatriation rules changed, and also individuals who expatriated after that date who would meet the definition of covered expatriates, which we'll cover in the very last slide. Gifts of U.S. side as tangible personal property and real estate are taxable, and an annual exclusion is available. And for purposes of the generation skipping transfer tax, which I'll explain in a moment, there's no GST tax at all unless the transfer was subject to gift or estate tax when it was made. In the United States, the estate tax applies to tax transfer of wealth at death. The gift tax applies to transfers of wealth during life. And the generation skipping transfer tax applies to transfers to people who are 2 or more generations below the transferor. The basic idea being that the government wants assets taxed at each generation without skip. So for an individual who's coming into the United States, there are opportunities to do some inbound estate planning. The basic goal is to receive the benefit of property without actually owning it for transfer tax purposes, so that when the individual residing in the U.S. Dies, that property will not be taxable in the person's estate. Inbound planning typically should be done before an inheritance is received. And there are fantastic planning opportunities available whether or not a person intends to remain in the United States permanently. Sometimes people will try to use offshore trusts or companies. We're going to talk a little bit later in this presentation about some of the tax and reporting consequences associated with them. I have done this successfully with U.S. trusts. Which are somewhat easier from a U.S. income tax and reporting standpoint. So as an example, imagine an individual comes to the United States from Germany, decides to stay, could become a citizen, could become a legal permanent resident, gets married and has kids. The person's mother remains in Germany, however. If mom goes and creates a trust in the United States for the benefit of her family that is now in the U.S. and contributes 10 million euros to it, there is no U.S. gift tax on mom. There is no generation skipping transfer tax, either when property is contributed into the trust or when distributions are made out to the beneficiaries. There's no limit to the amount that she can contribute from a U.S. standpoint. All of this obviously has to be cleared and coordinated with local counsel, but from an American standpoint, it is estate planning paradise because you can create a trust that could last in perpetuity for the benefit of mom's U.S. family that is free of the U.S. transfer tax system. The trust can be structured to avoid all U.S. income and capital gains tax during mom's lifetime. After mom passes away, there are choices about how the tax can be treated for U.S. income tax purposes. Generally, though, the trust would pay tax on gains, and either the trust or the beneficiaries would pay tax on the income, depending upon whether the income is distributed. And again, in the last bullet point, you can avoid transfer taxes for multiple generations or even into perpetuity. Okay. Shifting to non-citizen spouses. This is an issue that comes up a lot in estate planning in the U.S. And this is one of the instances in the tax laws where there is a truly hard distinction between people who are citizens and people who are not. So for income tax purposes and for many estate tax purposes, a resident is treated much like a citizen. For transfers to non-citizen spouses, however, citizenship does truly matter. The basic idea is that for estate and gift tax purposes, a marital deduction is only available if the recipient spouse is a U.S. citizen. If a marital deduction is available, then an individual can transfer unlimited amounts of property free of estate tax to a U.S. citizen spouse. The example I like to use is that if Bill Gates, the founder of Microsoft, wanted to do so, he could write a single-page will in which he would leave everything to his wife. At his death, there would be no tax, because everything would be covered by the marital deduction and go to his wife. At her later death, however, their combined assets would be subject to a tax. Now, the policy purpose of denying a marital deduction to a transfer to a non-citizen spouse is a concern that the spouse could take the money and run and just go back home, and then those assets would escape the U.S. tax regime. There are exceptions to this general rule, though. First, there is a special gift tax annual exclusion that allows a person to transfer up to $148,000 per year to a non-citizen spouse tax-free. That number is indexed for inflation. Transfers in excess of the annual exclusion during life use a portion of a person's exemption against the estate tax, which is $5.45 million in 2016. Transfers at death can be structured so that they achieve something like a marital deduction through the use of a qualified domestic trust, or QDOT. Basically, this is a trust that is created for the benefit of a surviving non-citizen spouse. If assets are transferred to the trust and the correct elections are made and the trust is structured in the right way, then there is no immediate estate tax and no immediate use of the decedent's exemption against the estate tax. In order to have a QDOT, you need a United States trustee. The trustee has to be responsible for withholding a special recapture tax on principal distributions out to the spouse, including at death. That tax is essentially a deferred estate tax on the estate of the first spouse to die. Income distributions are subject, though, to normal fiduciary accounting rules. And there are special rules in the United States for common situations that come up between spouses. So purchases of jointly owned real estate, most married couples own their houses jointly here, and joint bank accounts, joint brokerage accounts. There are rules that, if followed, will prevent an immediate gift upon the creation of a joint asset of that kind. But again, it's important to be careful. Speaking of houses, I threw in a slide here about purchasing a home in the United States. is it's something that people do even if they're not intending to stay forever. This is the sort of investment that some people will make for some period of years, whether they plan on moving here or just visiting here from time to time. So the tax treatment of real estate, again, depends in large part upon the immigration status of the peoples involved. For citizens and for non-citizen residents, if the house makes money, so if it appreciates in value, there can be a capital gains tax that's due when the house is sold. If the house loses money, then there can be a loss too. And real estate is subject to federal and state estate taxes at the owner's death. There's no sort of privileged position for real estate, including the primary home, for purposes of the transfer tax system. For non-resident aliens, things are a little more complicated. I had mentioned that for non-resident alien, or actually for non-citizen in general, there's a liability for capital gains if you're here at least 183 days during the year the gain is recognized. The rule, however, is different for sales of real estate. If a foreign seller sells U.S. real estate, then the seller is liable for U.S. income taxes and, in theory, is supposed to file a U.S. income tax return. Human nature being what it is, though, the government realizes that a foreign seller might not want to file a U.S. income tax return. So the tax is enforced in part through a withholding. The buyer is required to withhold up to 15% of the sales price of the property under the applicable law, which is the Foreign Investment in Real Property Tax Act. It's affectionately known as FIRPTA. The withholding actually increased at the end of last year. It had been 10% previously, but it's now 15%. Some people will go and try to own real estate through a foreign corporation in order to shield it from U.S. estate taxes. Remember, U.S. real estate is a U.S. citus asset that's taxable, whereas shares of stock in a foreign corporation are non-U.S. citus assets which are not subject to U.S. estate tax. If the foreign corporation sells the real estate, then there is withholding that is due. However, if an enterprising non-resident alien instead sells the shares in the foreign corporation to somebody else, there's no withholding that's due at that time under FIRPTA, but the new owner is going to take the old owner's basis in the real estate. I have a bullet here that says capital gains exclusion for primary residents available to non-resident aliens. In the United States, if you meet certain requirements, then a portion of the gain from the sale of a person's principal residence is excludable from tax. It's $250,000 for an individual or $500,000 for a couple. And that is available for non-resident aliens if the house qualifies as their primary residence. So for estate tax purposes, as I had mentioned, if that's a person's primary concern, they're not so worried about the capital gains issue. Avoiding direct ownership is a good way of planning around the real estate. So this could involve purchasing it through a foreign corporation or purchasing it through a trust that the person benefits from. Care must be taken to make sure that the trust is structured in such a way so that its property is not included in the non-resident alien's estate for U.S. purposes. Some people will also consider using a two-entity structure to purchase U.S. real estate. Typically, it would involve having a U.S. corporation make the purchase and having the U.S. corporation be wholly owned by a foreign corporation. which is in turn owned by the non-resident alien. Use of the foreign corporation shields the property from estate taxes if the non-resident alien dies while owning it, and use of the U.S. corporation can help minimize some of the income tax issues associated with owning the property. It's complicated, and certainly something I'm happy to chat about at greater length if people have questions. So, if purchasing a home in the United States, it's worth doing some planning and some thinking before committing to a particular ownership structure. An individual may be tempted to say, hey, I don't want to go and have somebody set up a trust for my benefit or create a foreign corporation. I'm just going to own the property directly and keep it simple. And then that individual could find that they leave the United States quickly or die. So it's important to go and think through a potential change in stature or a potential move that may be coming up before deciding to go and just take the easy way out and own the property directly. All right. So the next section here deals with so-called challenging assets. And by this, I typically mean assets that a foreign person who has come to the United States continues to own outside of the United States. This can be foreign accounts. It can be interest in foreign trusts or interest in companies or partnerships. It is perfectly legal and oftentimes very sensible for a individual to own accounts, investments, other assets outside of the United States in their home countries or elsewhere. The challenge, though, is that reporting requirements kick in once a person becomes a citizen or resident of the United States. And these reporting requirements are generally aimed at making sure that any U.S. taxes that are due on account of these assets are being paid, and also they can be aimed at either eliminating the deferral of tax or eliminating its benefit. And here's what I mean by that. So if a person owns, say for example, a company overseas and that company earns income, that income is not taxable in the United States until payments are made to somebody in the U.S. So it creates a great opportunity to defer U.S. tax on the income. The United States government has structured its tax laws to first find out about the existence of many of these companies, and again, second, to either eliminate that ability for deferral by treating something as a pass-through even when it typically wouldn't be, or by taking away the benefit, such as by imposing an interest charge on the deferred tax. When a person becomes a citizen or resident, again, as I covered in an earlier slide, worldwide income is subject to U.S. tax, and most of these assets have to be reported. When in doubt, the best thing to do is to report the asset and report the income and to be transparent, because the penalties associated with failure to do so often can be incredibly steep. This is a big area filled with traps for the unwary, and for a person coming to the United States, beyond reporting, the two best things that they can do are to coordinate with their advisors back home and to get a good accountant in the United States who can help walk them through some of these rules. So let's get into it. First asset that I have in mind is a foreign trust. So the U.S. tax laws create a binary division between foreign trusts and domestic trusts. A trust is a foreign trust if it does not pass both a court test and a control test. The court test is whether the trust would be subject to the supervision of a U.S. court. The control test is whether the trust is under the control of U.S. persons. And more specifically, do U.S. persons have the ability to make all substantial decisions relating to the trust? The tax regulations contain a list of a non-exclusive list of what qualifies as a substantial decision. It's basically anything you can do with a trust. So it's distribution decisions, investment decisions, decisions about crediting income and receipts and expenditures to income or principal, just about anything. If you end up with a foreign trust with either a U.S. donor or a U.S. beneficiary, there can be very challenging income tax consequences. So if you think about the instances when this would come up, this could be a trust created by an individual overseas. The individual moves to the United States, becomes a U.S. citizen or resident, and now they have a foreign trust with a U.S. donor. Or it can come up where a trust is created overseas for the benefit of any number of beneficiaries, some of whom are U.S. citizens or residents. So tax issues come up. One, you get grantor trust treatment if a foreign trust has a U.S. donor and any U.S. beneficiary. By grantor trust, I mean that all of the incoming gains earned by the trust would be taxable to the U.S. donor, even if the U.S. donor is not eligible to receive distributions from the trust. So all of the benefit of the trust can go to someone else, but the tax bill can be sent directly to the donor. If a person makes a transfer to a foreign non-grantor trust of appreciated property, that transfer can trigger recognition of gain. If a trust converts from a foreign grantor trust to a foreign non-grantor trust, you can also get recognition of gain. And this conversion can be because the last U.S. beneficiary goes away, or because the U.S. donor dies, and it's impossible under the U.S. Well, let me walk that back. Typically, under the U.S. Tax laws, you need a living donor in order to have a grantor trust. The big one that people are very wary of, though, is that distributions from foreign non-grantor trusts to U.S. beneficiaries can have negative consequences if they consist of income or gains accumulated from prior years. So if a foreign trust distributes all of its income and gains on a current basis, it's typically all right. If, however, it does not distribute all of its income or gains currently, but makes what's referred to as an accumulation distribution in a later year, then the beneficiary can face a throwback tax, where the tax on the accumulation distribution is taxed at higher rates from prior years. There can be an interest charge that is imposed in order to avoid the benefits of the deferral. The income can lose its character. So gains accumulated in prior years don't come out of the trust as gains. They come out as ordinary income and are taxable at a higher rate. It's generally a disaster. And the U.S. beneficiary and also the U.S. donor can have special reporting requirements. Foreign accounts pose their own problems, and there are multiple overlapping forms of reports that have to be filed. The most famous is the FBAR, Foreign Bank and Financial Account Report, and it has to be filed annually by persons with either financial interest in or signature authority over a foreign account if the aggregate value of all the foreign accounts exceeds $10,000. The form is filed electronically, I think in June. It's not on the same cycle as a person's individual income tax return. And a foreign account means more than you think it does. It's not only bank accounts, but also brokerage accounts, and can include life insurance, options, mutual funds. It's far-reaching, and the penalties can be stiff for failure to file these. There is a similar filing requirement imposed by FATCA, the Foreign Account Tax Compliance Act. It's a different form that is filed with a person's personal income tax return, and it's generally aimed at accounts over $50,000 in value. FATCA has been one of the big tax issues in the United States and also internationally over the past few years. It is a massive law with massive regulations that has created numerous treaties and is easily the subject of its own seminar or week-long seminar. I will say briefly, though, that FATCA becomes a relevant concern for a person who comes to the United States and becomes either a citizen or a resident, and resident under the green card test or the substantial presence test, because FATCA applies to citizens and residents. Briefly, it requires a 30% withholding tax on the payment of U.S. source passive income to foreign financial institutions unless the financial institution meets certain reporting requirements. And these include disclosing the identities of U.S. persons with accounts or certifying that there are no U.S. persons there. And again, once you become a citizen or resident, you're a U.S. person. Anecdotally, a lot of Americans are having difficulty opening bank accounts, checking accounts overseas because of FATCA. This should apply similarly to people from abroad who come to the United States, leaving some of these accounts behind, who then become Americans in the eyes of FATCA. So this is something that needs to be monitored closely. The next couple of assets that I'll discuss, and I'm going to move through them quickly in the interest of time, are foreign corporations and foreign partnerships. There are different types of foreign corporations in the eyes of U.S. tax law. One type is the controlled foreign corporation, which is a foreign corporation controlled by U.S. shareholders that has non-operating assets and passive income. It's generally treated for tax purposes as a pass-through, whether it's making distributions or not. And U.S. shareholders are supposed to file a specific information return. It's Form 5471. There's a $10,000 per shareholder penalty per year for failure to file the return. There's an entirely different information return that's filed if the individual is, if a U.S. shareholder is making a large capital contribution to a controlled foreign corporation with a 10% penalty for failure to file. I'll note that if a transfer to a controlled foreign corporation is made by a partnership, the domestic partners, not the partnership itself, must file. I've seen this be a problem in investment context because it's often very difficult for the individual partners to get this information. Foreign partnerships are partnerships that are controlled by U.S. partners, and again, reporting requirements come up. So for example, if there are large capital contributions, or if an individual controls the partnership by holding a 50% or more interest, Form 8865 has to be filed. There's a penalty for failure to file. The penalty depends upon the type of partner involved, but you can figure at least $10,000 for failure to file, and then that $10,000 can increase after notice from the IRS looking for the return. Switching back to corporations, foreign mutual funds are often treated as what are known as passive foreign investment companies, or PFICs. A PFIC is a foreign corporation where either 75% or more of the gross income during the taxable year is from passive sources, or 50% or more of the assets are assets that generate passive income. These can be incredibly challenging to deal with. There are different tracks that an individual can follow for purposes of taxation. You can, for example, make an election to treat it as a pass-through, very much like a U.S.-based mutual fund. This is qualifying electing fund. You can elect to make a mark-to-market election where the PFIC is treated as being sold at the end of each year, and any gain on the sale is treated as ordinary gain. Absent an election, though, there is an income tax regime that kicks in where a person receives an excess distribution, which is 125% of the average distribution received by the shareholder over the 3 preceding years. If that happens, then there is an income tax that's charged plus an interest charge, with the idea being that that excess distribution must be flushing out previously earned income that had been deferred. PFICs should be monitored closely. They're very difficult sometimes to snuff out on people's income tax returns, and it can take a lot of work in order to report them correctly. The last topic I'm going to cover, and I'm going to cover it quickly because I know that we're drawing to the close of our hour, is expatriation. So I've mostly discussed what happens when people come to the United States, what estate planning considerations should they make, what tax changes should they expect. Expatriation is the process of leaving. And by leaving, I mean it's a U.S. citizen who renounces his or her citizenship, or also a long-term green card holder who renounces or loses residency. And for these purposes, a long-term green card holder is a person who is a legal permanent resident for 8 out of the prior 15 years. If a person falls into those categories and also is a covered expatriate, then there can be an exit tax. A covered expatriate is an individual who has a high income, so it's a person who's had an average annual income tax over the last 5 years of $161,000 or more, has a net worth of at least $2 million, or someone who fails to certify that they've been compliant with U.S. tax law for the last 5 years. So if you get in a covered expatriate and the person expatriates, then the covered expatriate is treating it as having sold all of his or her assets on the way out of the United States. It essentially makes expatriation a gain recognition event. There is an exclusion. It's $693,000 in 2016. But after that exclusion is chewed through, the covered expatriate owes capital gains tax. And there are special rules for things that can't really be sold, like interest in deferred compensation or interest in non-grantor trusts. Those are covered through a withholding tax. I have talked with clients in the past who've thought about doing this. They've done the calculations and figured that they can live with the exit tax. But typically what I have found is that people have a great deal of difficulty with one other facet of being a covered expatriate, which is an inheritance tax. So I told you earlier that the estate tax and the gift tax in the United States are paid by the transferor, not the transferee. There is a special inheritance tax, though, in the case of gifts and bequests by covered expatriates to U.S. persons. that is an instance in which the recipient of the gift or bequest pays the tax. It's assessed at the highest marginal rate in effect for the year. In 2016, it's 40%, and it's a flat tax. So if you can imagine a client who's come to the United States, held a green card for 20 years, had children in the United States who are U.S. citizens by birth, and then decides to go home. If the person qualifies as a covered expatriate, he or she can leave after and will need to pay this exit tax. But when that person dies, if in the usual course of events his or her assets pass to the children, because those children are citizens receiving property from a covered expatriate, they pay the gift or estate tax. In the conversations I've had with clients, that's often been a deal breaker. So that is the presentation. I know that there's a way for people to ask questions through a chat system. I'll hang on for a little while and see if any questions come up. Otherwise, you have or will have my contact information, and I would be happy to talk to you in the future.
Thank you, Matt. That was great. As you said, we can wait for just a couple minutes here to see if anybody has any questions. But I will be sending a communication to everybody who registered in the next few days. That will include your contact details as well as your presentation. We recorded the webinar today, so I will send that on as well in case anybody wants to re-listen to it or send it off to somebody else who might be interested. So don't hesitate to reach out to Matt after the webinar in the next few days or when something comes about. And I think that's it. Matt, do you want to wait for a couple more minutes, or you want to just have people contact you directly?
I'll give it another minute, and then after that people can contact me directly.
Sounds great.
Okay, I don't see any questions coming in, so everybody have a nice day, and I hope to hear from you in the future.
Great. Yep. Thank you, Matt. Thank you, everybody, for joining us.
Thank you. Take care.
Bye.
Bye.